Imagine saving thousands, if not tens of thousands of dollars every single year on your taxes just by understanding a few key tax strategies that most business owners overlook. Sound too good to be true? Well, it's not. In this video, we're going to be breaking down three powerful tax strategies every Canadian business owner should know. Number one is the Section 85 rollover. Number two is the benefits of a holding company. And number three is a well positioned asset purchase. But before we dive in, a quick disclaimer. This is a general tax advice simplified to make it easier to digest. Tax laws are very complex and personal circumstances do vary. So don't rely solely on this video alone. If you want a tailored tax plan or tax strategy, click the link below and book in a call with myself or one of my team members. Also, these strategies may not be right for you. If you're unsure or want something customized to your exact unique situation, then like I said, pick a time down below that works for you and we will get you one. Now, let's get started and show you how these strategies can work for your business. Let's start with number one, introducing a holding company. Why this is important and beneficial? There are many reasons such as asset protection, lifetime capital gains exemption, tax savings, tax deferral, and estate planning. For the sake of your time, I will give you a quick example of one of my favorite and the most popular, which is the lifetime capital gains exemption and asset protection. So let's start with number one, a holding company that helps business owners qualify for the lifetime capital gains exemption by passive investments, stock, or real estate, which is separate from the operating company. The lifetime capital gains exemption allows Canadian small business owners to sell qualified small business corporations shares and avoid paying taxes on capital gains up to and over $900,000 per individual in 2025. So, for example, let's say that you own a bakery, okay? It's an operating company and you plan to sell it for $1.5 million. For the lifetime capital gains exemption to apply, at least 90% of that bakery's assets must be actively used in the business. However, over the years, you've accumulated $300,000 in passive investments, maybe GIC, stock portfolios. Without a holding company, these passive investments could disqualify your shares from the lifetime capital gains exemption. But by moving the investments into a holding company before the sale, you can ensure that the bakery meets the exact criteria and qualifies for the exemption, saving you potentially hundreds of thousands of dollars in tax that you would have otherwise had to pay. How can a holding company help you for asset protection? Well, for example, a holding company protects all of the retained earnings, investments, and other assets of an operating company from any legal liabilities or outside threats. Imagine you own a operating construction company, okay? The company generates $500,000 in annual profits, which you reinvest into equipment and retain as cash inside of that business. If your operating company ever gets sued for any kind of workplace injury, those profits and all of those equipments and assets could be vulnerable to any legal claims. But by setting up a holding company, you can transfer excess cash or retained earnings into that holding company through a tax-free intercompany dividend. This keeps those funds out of reach from any outside threats or lawsuits tied to the operating company. While the construction business remains exposed to any liabilities or lawsuits, your wealth and cold hard assets stay inside the holding company, well protected. Now, you may think, I've never had any injuries on my job site or on my locations or whatever. And this goes back to the good old truth. It'll never happen to you until it does. Moving on to strategy number two is a Section 85 rollover. Now, what is a Section 85 rollover and why should you care about it? Section 85 rollover is a very powerful tax strategy that allows you to transfer assets into a corporation without triggering any immediate tax bill. It's almost like hitting the pause button on capital gains tax. It enables you to move assets into another legal tax-paying entity in a more tax-efficient way. Here's a very common scenario and something that I see a lot. Let's say that you own a property under your personal name, but you want to move it into your corporation. Well, without using a Section 85 rollover, this transfer would be considered a taxable event by the CRA. Why? Because the CRA would treat the transaction as if you sold the property to your corporation at fair market value, which is a separate legal entity. So, imagine you bought a property 5 years ago for $100,000, and today it's worth $300,000. If you transfer that property into your corporation without a Section 85 rollover, the CRA will deem that you sold it at fair market value and tax you on the $200,000 capital gain. capital gains are taxed at about 50%, meaning you'd pay tax on $100,000, which could cost you around $50,000 or more depending on your certain tax situation and bracket. This hefty tax bill makes transferring the assets into a corporation a very expensive move. Now, unless if you use a Section 85 rollover. How does the Section 85 rollover help? Well, with the Section 85 rollover, you can transfer the same property or other eligible assets into your corporation tax-free. Instead of triggering an immediate tax bill, you roll the assets into the corporation at the original cost base. In this case, if it was the property, it'd be $100,000. This means there's no capital gains that are realized at the time of transferring, and you avoid that $50,000 plus tax bill. Now, how much does a Section 85 rollover cost? Of course, implementing this strategy, it's not free. You'll need a team of tax professionals, including tax accountants and lawyers. But to properly execute this exact transaction, depending on the complexity of the actual asset and situation, fees typically range from anywhere from $4,000 all the way to $8,000. Let's look at it like this. Would you rather pay $4,000 to $8,000 in professional fees, which you can expense, by the way, or $50,000 in taxes, which you can't expense? Even if the fees ran you over $20,000, you'd still be saving $30,000 in taxes. That's money that can either stay inside of your business or be reinvested for whatever you want. Now, you might wonder, what can be rolled over? Section 85 isn't just limited to real estate. It can also be used for any eligible assets. A few examples would be shares of a business, equipment, investments, and other property types. This strategy is very incredibly versatile, and it can be tailored to meet the specific needs of your business or your estate planning goals. In summary, a Section 85 rollover is an essential tool for every Canadian business owner and/or investor who wants to move assets into a corporation or any separate legal entity without facing any unnecessary tax consequences. It's a clear example of how smart tax planning can save you tens of thousands of dollars. If done correctly and with the right team of professionals by your side, you'll do just that. Moving on to the third tax strategy, a well-positioned purchase versus a poorly positioned purchase. A well-positioned purchase is exactly what it sounds like. It's a strategical, structured purchase designed to maximize tax efficiency, protect assets, and reduce financial burdens. So let's break this into a concept that's a little bit more easier to understand. This is what a poorly positioned purchase would look like. Let's meet Bob, okay? Bob is a successful contractor who's crushing it. He's earning $100,000 per month in profits every single month. Bob decides that he wants to give himself a little reward for everything that he's done. And he wants to buy a $45,000 Rolex Datejust. It's a luxurious timepiece that he's always wanted. But here's the catch. To afford that Rolex, Bob needs to take out $45,000 from his business. But since Bob already claims personal remuneration, aka income, of $100,000 annually through a T4, this extra $45,000 will bump him into a total income of $145,000. But there's more. Because Bob lives in Canada, that extra $45,000 is subject to personal income tax. Now, depending on the actual province, Bob could face tax rates as high as 40 to 50% on this additional income. This means to take home $45,000 after tax, Bob might need to withdraw over $75,000. So Bob's Rolex just turned from $45,000 into $75,000, all because of a poorly positioned purchase, also known as PPP. Let's rethink this. Instead of withdrawing personal income, Bob could have structured this as a corporate investment. How and why? Well, because a Rolex isn't just a watch, it's a luxury asset. Depending on market demand, this can either go up or go down in value over time. And here's the thing, the CRA doesn't get to decide or dictate what Bob or you or I think is a valued and good investment. By having the corporation purchase the Rolex as an investment, Bob can enjoy several key advantages, starting with number one. His Rolex asset is now protected. The Rolex purchased under the corporation is treated as a corporate asset now. Corporate investments are much safer because they're held within the business and are protected from personal liabilities. If Bob's personal finances were to ever face any kind of challenges or hardship, the Rolex remains shielded as a corporate asset and protected. Number two is tax efficiency. Corporations pay lower tax rates on retained earnings compared to personal income. So instead of taking out the $45,000 as personal income and paying up to 50% tax, Bob's corporation can purchase that Rolex using funds at a much, much lower tax rate, saving them thousands of dollars in tax. And number three is investment growth flexibility. If the Rolex increases in value over time, the corporation can sell it and benefit from the capital gain treatment. Capital gains earned within a corporation can be structured to minimize taxes, potentially reducing the taxable amount by up to and over 50%. Bob could also transfer that Rolex into a holding company or trust for even more tax efficient planning. And number four, it's not a huge one, but it does count. Enhance financial statements. Investments like luxury watches improve the corporation's financial profile. Having a valuable corporate asset on a balance sheet makes the business look stronger, which can help Bob secure any kind of loans, financings, or possibly attract investors. Number five is estate planning. If Bob eventually wants to pass down this Rolex or other corporate investments to his family members, the holding company can facilitate the transfer in a tax efficient manner, reducing the estate tax burden. Now, whether you roll that out with a holding company or with a Section 85 rollover, that depends. The bottom line is by purchasing the Rolex through the corporation, Bob achieves tax savings by avoiding personal income tax on the actual capital withdrawal, assets protection by keeping the investments within the corporate structure, flexibility to grow and transfer the investment within a minimal tax implications. So, while Bob could have made a poorly positioned purchase, he instead makes a well positioned purchase, leveraging the power of his corporate tax strategy to save money and protect assets and grow his overall wealth. In conclusion, this is just one example of how strategic tax planning can transform your financial decisions, whether it's a Rolex, real estate, or any other type of investment. Structuring your purchase the right way can save you tens of thousands of dollars in taxes and future liabilities. If you want personalized advice on a well-positioned purchase or other strategies, then book a call down below to ensure that you're making the most out of all of your hard-earned money. Now, let me be absolutely clear. The strategies that we just went over today are general examples based on what we've successfully implemented for clients in the past. Every situation is unique with benefits and etiquettes, and these strategies should never be implemented without consulting a qualified professional. Now, when I say qualified professional, I mean someone who specializes in advanced tax planning, such as a tax lawyer or tax strategist, not just a regular CPA or financial advisor. You want someone with the right credentials, something like a 3-year in-depth tax strategy certification, which provides an in-depth understanding of the Canadian Income Tax Act and its nuisance. To give you a quick example, someone who gets their CPA, they're educated and they're taught about 30% of all of Canadian tax laws. The other 70% goes uncovered. But unless if you have your 3-year in-depth tax strategy certification, this covers the remaining 70% and more. Another qualification is a TEP. What is a TEP? Well, that's short for Trust Estate Practitioner. This is crucial for building robust tax and liability protection for your family and business. Our tax strategists hold all of these qualifications, giving us the expertise to uncover opportunities and identify legal loopholes that others may miss and often do. So, if you're ready to discover what's possible for your business and explore custom tax strategies designed to save you thousands of dollars, if not hundreds of thousands, then book a call down below. During our consultation, what we'll do is we will dive into tailored tax solutions that will align with your goals. And rest assured, we only take on engagements where we're confident that we can deliver significant value. We're not in the business of wasting your time or creating unnecessary work. So, if you're a Canadian business owner generating over $200,000 in annual sales, then click the link below, book in a time that works best for you, and let's explore how we can transform your tax strategy and unlock real savings for your business.